Hello everyone. I'm welcoming you all for another past paper discussion of strategic level advanced business reporting subject. In previous sessions, I was discussing two past papers, LKAS 40 investment property as well as SLFRS 16 leasing. Past papers were discussed. Today I'm going to discuss the past paper question on LKAS 23 borrowing cost standard. So let me share the slide. Right, hope you all can see the slide. Okay, as I mentioned, today we will be discussing about LKAS 23. Before focusing on the past paper question, I would give brief introduction about LKAS 23 borrowing cost. Let me go to my whiteboard. Yes. Now, when it comes to LKAS 23 borrowing cost, there are two eliminations when it comes to the scope of the standard. Two things to be eliminated. So let me write those eliminations. That means under the scope, so we need to eliminate two things. The first one, you should eliminate biological assets. Biological assets. Biological assets. Right? Sometimes entity can identify that one as qualifying asset. I will explain what qualifying asset is. If qualifying asset categorized under biological assets, it could be identified, or the borrowing cost related to qualifying asset of biological assets, it could be identified based on LKAS 41, not LKAS 23. There is another one, inventories. Inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. For an instance, manufacturing of whiskey, alcoholic product. So it could be manufactured repetitive basis in large quantities. So in this type of, even though this is a qualifying asset, because it will take some considerable amount of time. Okay, so that could be identified as qualifying asset. Even though that is a qualifying asset, if that is manufactured in large quantities in repetitive basis, that would be eliminated from the scope of LKAS 23. Then we'll move to definitions of borrowing cost standard. Basically, I would like to focus on two definitions. First one, borrowing cost. Second one, qualifying asset, borrowing cost and the qualifying asset. So we'll try to understand about these two terms. First one, borrowing cost. What do you mean by borrowing cost? The borrowing cost means interest and other expenses. I will write, so you will be you can write them in your books. So therefore I would write on my whiteboard: interest and other expenses, interest and other expenses incurred by a business, in connection with the borrowing of funds, For an instance, most of the cases, entities are obtaining loans. Sometimes entities are manufacturing or constructing some qualifying asset. I will explain what qualifying asset is. So those projects are financed by borrowings or else loans. So for loans, entity should pay interest. In addition to that, sometimes when entities are obtaining loans, there are some fees directly attributable to that particular loan. For an instance, lawyer charges, stamp duties, etc., etc. So those things, those expenses also could be identified as part of borrowing cost, not only interest. Okay, so you can clearly see based on the definition of borrowing cost. Right, then we'll move to qualifying asset. What is qualifying asset? Already I have given some hint on qualifying asset. So let me write the definition of qualifying asset, then you will be able to understand. Qualifying asset is an asset that takes a substantial period of time to get ready for its intended use or sale. Okay, let me explain that one through an example. Let's say this is RLA entity. Okay, this is our firm or company. So this, suppose now you need to think in RLA entity's point of view. RLA entity could purchase a motor vehicle. Right, RLA entity could purchase motor vehicle, has purchased motor vehicle 8 million. So this 8 million obtained from a bank. That means this particular motor vehicle purchased on loan value, right? That means company obtained loan and invested that one on a motor vehicle, right? Okay, for an instance, right, you suppose that's how it has happened. Now this particular motor vehicle can be used within very short period of time, maybe 1 or 2 days. This particular motor vehicle can be used by the firm. So can you identify this motor vehicle as qualifying asset? Can you recognize this motor vehicle as a qualifying asset? What would be the answer? So you should say no, this is not a qualifying asset. Why? There is no such considerable amount of time period. There is no such considerable time, right? Or substantial period of time. Therefore, this is not a qualifying asset. So this interest on this loan should be charged into P&L. Why? This is not a qualifying asset. Okay. On the other hand, let's say there is a building, there is a land. On this particular land, the early entity constructing a building, right? Now early entities land, they are early entities constructing a building. Now in order to use this particular building, it will take time. Because this is constructing from the initial ground or planning works, right? Then they need to find contractors. Likewise, there are many activities, step by step they need to do that. So it will take time, maybe 6 months, maybe 1 year, 2 years, maybe 3 months, but there is no such threshold in the standard. This is in order to be a substantial period of time, this is the minimum amount. No, there is no. So that's a judgment. Of the firm, right? So this particular building could be identified as a qualifying asset. So if early entity obtain loans to finance this particular construction of building, so that interest or borrowing cost can be capitalized to the building as a cost of the building. Otherwise, generally we are charging interest expenses to the P&L. But if we have obtained loans for qualifying assets, we can charge that particular borrowing cost or interest to the respective qualifying asset based on some conditions. Those conditions I will be explaining. There are suspension and cessation of borrowing costs. So we should understand clearly when to start, when to stop, and when to suspend, right? Okay, so I hope you got clear understanding about qualifying asset. Okay, maybe inventory can be a qualifying asset if that is take substantial period of time to complete that particular product. Maybe it can be identified as a qualifying asset. Then that particular interest, if that the manufacturing process financed from a loan, so loan interest can be capitalized to the inventory that could be recorded. Ultimately that could be recorded as a part of cost of sales, otherwise we would be charging into the interest expenses, right? So not only motor vehicle, not only building, lands, no. So the inventories also could be identified as qualifying assets. If it is in line with the definition, right? Okay, I hope you understood up to that point. Then I would like to emphasize here measurement, how we are going to measure borrowing cost, right? This is very important. sometimes loans are obtained to a specific project, specific qualifying asset, right? Then that's very easy. That's very easy. So that particular interest or borrowing cost can be capitalized into the qualifying asset, relevant qualifying asset. But sometimes entities are obtaining several loans from different banks at different rates. That's called common pool. There is a common pool. Sometimes not only for the construction of building or the building qualifying assets. Sometimes in order to run the business, they have obtained some loans. There is a common loan, common pool, right? Then when entities are running, those money, sometimes the loan amount would be taken into construct or build qualifying assets, right? Then there is a problem how to identify or how to measure the borrowing cost to be capitalized into such qualifying asset, right? Standard clearly mention how you are going to how this measurement should be done based on the standard. So let me explain that. We have to have capitalization rate. Capitalization rate. Okay. So capitalization rate equals interest, because there are many loans at different rates. Sometimes different loans, maybe debentures, maybe bank loans. Likewise, in different methods, the entity can obtain loans, right? So interest divided by weighted average debts. Weighted average debts into 100. So this is capitalization rate. So you would be getting some common rate, even though there are many rates in different borrowings. Ultimately, we are going to calculate one rate, that is called capitalization rate. Then what you are going to do, this particular rate need to be applied to the amount of debt, amount of debt incurred on qualifying asset into capitalization rate. Capitalization rate. So this is the amount to be capitalized. Amount to be capitalized. So borrowing cost. Borrowing cost to be capitalized. Amount of debt incurred on qualifying asset multiplied by capitalization rate. So this is capitalization rate. Now you can write these two equations clearly. Okay. Right. Then next point, suspension and cessation. Suspension and cessation. What do you mean by suspension? What do you mean by suspension? Sometimes entity needs to suspend the manufacturing process or else development process due to sometimes some labor disputes. Maybe 2 to 3 months or 1 month there is no such work, right? So if that is the case, then due to that the total project duration will extend. Due to that, total project duration will extend, right? As a result, the time period will increase, then the capitalization rate also will increase. Therefore, standard clearly mention, if there is a suspension, work suspension like that, due to those reasons, maybe labor disputes and all, we can suspend capitalization as well. During that particular period, the borrowing cost should be charged into P&L, not into the qualifying asset. Not into the qualifying asset. That particular time period, suspension period, charge into the P&L, profit and loss. Then cessation means when to stop capitalization of borrowing cost to the qualifying asset. Right? When the asset is ready for sale or use, the entity should stop capitalization of borrowing cost. Right? Please keep that in your mind. So all the activities, let's say there is a big building, the already constructions completed, but there is a remaining work to decorate around the building. But building construction is already completed. There are minor things. For minor things, it will take around 1 month. But standard clearly mentioned that minor things is not significant. Therefore, the borrowing cost capitalization should be ceased or stopped when that particular building, the main building, the construction part is completed. Right? So please keep that in your mind. However, when it comes to suspension, sometimes there are natural requirement. That is normal. There is we cannot control as entities. We cannot control. That is beyond our control. For an instance, suppose we are constructing a bridge. Right? Sometimes when we are constructing that bridge, we need to put some bases under the river. Then if there is a water level, high water level, how to do the work? Maybe we need to wait until the water level is getting down. Right? We're getting down. So that particular period we can consider that's normal. So in the long, when we are planning, that has been considered for a total duration of the project, because that is normal. Right? 1 or 2 months in a year, because of the raining, that water level of the river would go up. That is normal. So during that particular period, generally we are not going to suspend the capitalization, because that is normal, natural, and beyond our control. Right? I hope you can understand the difference between labor dispute and the normal or natural things. Right? Okay, please keep that in your mind. With that brief explanation of LKAS 23, I would like to discuss one of most recent past papers, that is December 2020, question number 1, part B, strategic level advanced business reporting. Strategic level advanced business reporting, December 2020, that's online examination. So we'll discuss the answer for that particular question. December 2020, question number 1, part B. Right. So there is in the paper they have indicated as A. There are 2 A's. That's a mistake. So it should be B. Should be B. Because I directly took this particular the question from the paper itself. It's a screenshot. So this should be B. Right. Now I will give you a couple of minutes to read this question. Read this question. Right. Okay, let me read. IPL purchased a land to construct an apartment complex on 1st of January 2018 for 30 million. First they have purchased a land to construct a building on 1st of January 2018 for 30 million. This is land value. Land value. The company spent 2 months on planning activities, and on 1st of March 2018 the planning approvals were obtained. Now please underline that 1st of January 2018 the land was purchased and company spent 2 months on planning activities. Underline this, planning activities. You know, any work so anything in our life, the planning is essential. We need to spend time for planning. If we miss that planning, so entire thing can be get wrong, right? So planning is essential. So here also they have done planning activities for 2 months, and 1st of March 2018 the plannings approvals were obtained. Development of the land was also completed. Here the development of the land, so there was some kind of works going on from 1st of January 2018 to 1st of March 2018. The planning as well as the development of the land also completed on this date, and construction commenced immediately after obtaining the approvals. Obtaining the approval. Right, now what is the conclusion? What is the conclusion? When now you have been given 2 days, 1st of January 2018, 1st of March 2018. Now you are considering when you are going to commence, when to start your capitalization. So I forget to tell you, there are few conditions to be checked when it comes to commencement of capitalization. Could you please go to, I will be going to my summary, then you can write somewhere in the summary, commencement, 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 commencement of borrowing cost, commencement of capitalization, right? So there are 3 conditions to be checked. All these 3 conditions should be complied. First one, incur expenses on the asset. Incur expenses on the asset. Second one, incur the borrowing cost. Borrowing cost. Third one, performing activities required to prepare the asset, for its intended use. Or sale. Okay. So these are the 3 conditions to be satisfied in order to start or commence the capitalization. Okay. Now based on this explanation, now you can apply that knowledge into this particular question. Now there are 2 days are given. 1st of January 2018, 1st of March 2018. So what is your judgment? When to start capitalization? Now I have highlighted two things: planning activities and development of the land. Right? Can you construct a building without developing the land? Sometimes there are many trees available in that particular land, so we need to develop that land. Then only we can do the construction. So in order to construct a building, so that land need to be developed up to, based on the conditions, based on the requirements of building construction, that land also need to be developed. So that particular activity has been started on 1st of January. So capitalization of borrowing cost can be started on 1st of January 2018. Right? Okay, so please keep that in your mind. Then the estimated cost of construction was 150 million. The construction was temporarily suspended. Here, temporarily suspended due to COVID-19 from 11th March 2020 to 10th March 2020. So how many months? 11 March to 10th May. April, May, only 2 months. Only 2 months. Now this is suspended due to COVID-19. So you have mixed judgments, right? Mixed judgment. One can argue that this is beyond our control, so this could be identified as, even though the activities are suspended, there is no such impact to the total duration, because 2 months, maybe compared to total time duration, total project duration, 2 months is sometimes small, right? And the management of the business can judge that even though the 2 months works suspended, there is no big impact on the total project duration. Therefore, even though no works happen during that particular 2 months, continue the capitalization. This is like water level of a bridge construction. So more or less similar with that particular example. But one can argue that, on the other hand, another one can argue that no, the total duration of the project will exceed because of this particular suspension. Then what you can do, you can give a judgment that we can suspend capitalization of 2 months for this particular time period and charge that particular interest into the P&L rather than capitalizing into the building. Right? So I will be giving based on two assumptions, two judgments, right? Two judgments. So you need to write your judgment. Then based on your assumption, you can write your answer in the examination as well. Right? Clearly state your assumption. Right? Based on that assumption, you can write your answer. Okay? In this discussion, I will give both ways. Right? Okay. Now let me continue reading of this particular sum. Now we have identified 2 months, right? Suspension. So we are going to do in two ways. We can consider 2 months as suspension, and second method is we can even though no works happen during these 2 months, we can continue capitalization, assuming that there is no such big impact to the total duration of the project. On 30th September 2020, the apartment complex was ready for sale except for a few modifications, some units suit buyer's specifications. Few modifications, disregarding. Few modifications, no worry. You need to stop your capitalization on 30th September 2020. right? The starting date 1st of January 2018, closing date 30th September. September means 9, 2020. So how many months? How many months? For 2018, 12 months. 2019, another 12 months, right? 19, another 12 months. If we disregard these 2 months, sorry, that is happening in 2020, no? So 2020, how many months? Disregard these 2 months, and so here you have 9 months, okay? The 9th of 30th of September, no? So altogether how many months? Altogether, so let me take my calculator. 24 and 33, yeah? 33. Yeah, 33. Okay. Now based on our assumption, now here 33 months. Based on our assumption, we can decide whether we are removing 2 months or not. Okay. So I will be providing based on 2 assumptions. Okay. Right. Now, all 3 modifications were completed on 15th October 20. So this date is not important as such. Why? We stopped our capitalization on 30th September 2020. Okay, let me continue reading. IPL made the following payments to the contractor. Right? Now, amount in millions. Phase 1, Phase 2, Phase 3. Phase 1, they have the 1st of March 2018. So this is the construction starting date. 40 million. 1st of March 2019, another 30 million spent. Altogether 70 million spent for the first phase. The second phase and third phase, these are the days that company incurred those costs. Here 50 million, here another 30 million, altogether 150 million, right? Right. Total payment is expected cost is 150 million. That's how the entity has spent that amount. Now we'll see how much entity has obtained as a loan. The following information is related to IPL's borrowings. Now, this is important. So we are going to calculate the borrowing cost now. Now on 1st of January 2018, IPL obtained loan of 100 million specifically for the apartment complex project at annual interest rate of 14%. Specific, this is important. Specifically for the apartment complex, right? That is not a common loan. That is specifically obtained in order to construct this building, right? 100 million obtained, not for other reasons. Not for other reasons, right? Then, since 100 million obtained, but there are few dates, the payment dates, right? So this particular loan obtained on this date, so they can, the entity can invest them temporary and earn some interest. Right? Because there is a specific dates to be paid to the contractor. So during that particular period, entity can invest that particular loan amount in some temporary investment and can earn some interest income. So if there is such interest income, what you need to do is you can deduct that interest income from the borrowing cost. That's how you should do. You cannot charge that one as interest income. So you need to deduct from borrowing cost. So please keep that in your mind. Okay, please keep that in your mind. Okay, which is equivalent to the effective interest rate. You know what effective interest rate means. As per SLFRS 9, we need to recognize interest expenses as well as interest income. So that's vice versa, based on SLFRS 9 effective interest rate. The loan is repayable over 5 years, an annual amount of 29 million. This is installment. IPL earn interest income. See, this is what I said. 1.7 million by temporarily investing the funds until the payments were made to the contractor. Right? So they are using that particular loan to construct this particular building, apartment complex, 100 million, right? So entire loan would be utilized to the building, not for other purposes. Therefore, you can recognize borrowing cost on this particular building. So how you are going to do that? Then second part, phase 2 and phase 3, the construction were financed by IPL's existing borrowings. That means existing pool. Details of existing borrowings of the company during the construction period are given below. This is a pool, loan pool. They have, so let's see that one. Right, there are basically 3 types of loans. The loan obtained at 12% per annum had outstanding amount 20 million as at 1st of August 2019. So it has been obtained 1st of August 2019. This loan was fully repaid on 1st of October 2020. Fully repaid on 1st of October 2020. Now, annual interest rate 12%, loan amount 20 million. Here, this is a loan, another one is a debenture. Somehow they have obtained loans, right? They have borrowed money. 13%, see, now rates are changed. Different rates. Right? Different instruments, so different rates, because risk levels are different. So, debenture issued at 13%, the outstanding amount 35 million. 1st of August 2019, same day that these dates, the figures are given. This remain unchanged as at 15 October 2020. Remain unchanged. It has not been repaid. Then third bullet point, a loan obtained 11% per annum had outstanding balance 50 million, 1st of August 2019. Okay, 1st of August 2019. The amount was fully settled on 15 November 2020. Right, now what you need to do? So you need to calculate that capitalization rate. Then the amount used in order to construct this building based on these dates, because that is applicable for phase 2 and phase 3, not for phase 1, because clearly mentioned, see, phase 2 and phase 3 construction were financed by IPL's existing borrowings. Right, so you need to apply that particular capitalization rate to the phase 2 and phase 3. Okay, right. But the phase 1, there is no such issue. There is one loan obtained for the entire apartment project. Right, so we will be calculating borrowing cost separately, specific loan as well as common pool. So we'll calculate the borrowing cost now. So required things: advise the management of IPL to borrowing costs that should be capitalized to the apartment complex according to the requirement of LKAS 23 borrowing cost. Assume that the amount of borrowing cost capitalized during the period does not exceed the amount of borrowing cost incurred during the period. So that's assumption. You can earn 10 marks. Right, now sometimes you felt so very difficult. There are many things to be applied, there are many rates, but don't worry, this is a very easy question, very easy question, right? If you can remember, I explained the logics behind present value and the future value. Present value and the future value when we were discussing SLFRS 16. SLFRS 16. So you please go and watch that particular video in the YouTube CA Sri Lanka website, YouTube channel, right? So in that particular video I explained how to calculate present value, how to calculate future value and all, right? The time value of money concept. Here also you can apply, because you are given installments. This is a loan, no? There is a repayment. So you need to calculate the interest year by year. Interest year by year. So we'll do the calculation now. Okay. So those who have not watched that particular video, please watch that video as well. Right. Okay. Now I'm going to give you the answer. Let me go to my whiteboard. Okay, answer for the question 1, part B, December 2020. December 2020. Okay, so we'll write first. We can write some theoretical part based on the standard. You can write. Okay, so I will be writing in my whiteboard, so you also can write it. But maybe some students are checking your answers, but some students independently answered based on your thinking. Then by watching this video you can mark by using your red pen, right? Otherwise you will be getting first experience in your final examination. You are using your brain to think first time in your final examination. Sometimes then in the final examination you felt difficult. Therefore my advice is to answer these questions in advance independently. Then once you answered, you can check with these videos as well as you have suggested answers, right? You can compare and see. But based on the experiences I'm sharing this, most of the students, what they are doing is they are checking the answers. They are not attempting to answer the question, right? The first experience that they are going to get in the final examination, and that's a disaster. Right? So please answer past paper questions independently, right? Okay. Right, now I will be giving the suggested answer. The construction project takes a substantial period of time to complete complete. Thus it meets the definition of a qualifying asset. Right? Then what you can write, as per LKAS 23, capitalization of borrowing cost should be commenced when all of the following conditions are satisfied. Following conditions are satisfied. We'll write one by one. First one, incur expenditure for the asset. Already we have written them. Incur expenses on the asset. Incur expenses on the asset. Second one, incur borrowing cost. Third one, undertakes activities that are necessarily to prepare the asset for its intended use or sale. Right? Then now already I have discussed the answer, so this is writing time. Okay, now I already told you the starting date is 1st of January 2018, not 1st of March 2018. So let me write it. On 1st of January 2018, IPL purchased the land and loan was obtained, and the loan was obtained. It also started activities required to develop the land and obtain approvals. Underline, develop the land and obtain approvals. Therefore, IPL can commence capitalizing borrowing cost on 1st of January 2018. Then please write down these things. That's why I gave a time, couple of minutes. Then you can write the borrowing cost incurred during the suspension period and after completion of the construction, after completion of the construction, the borrowing cost incurred during the suspension period and after completion of the construction should be charged to the P&L. Charged to the P&L on the basis that suspension of 2 months period would extend the project beyond the planned date. Beyond the planned date. Beyond the planned date. As I mentioned earlier, the management can judge the total duration of the project would not be affected, so they could continue the capitalization of borrowing cost even those two time period as well, 2 months as well, right? So I will be answering two assumptions, so we'll write that one as well. The management may also not consider the 2 months as a short duration given the total project period. Management also not consider the 2 months as a short duration given the total project. Write down. Remember, the short or long, that is purely a judgment of the management, purely judgment. Right. Okay, so these are the important things to be written. So now we'll calculate, and in addition to this you can write the temporary investment of borrowings or debt, and as a result there is an income, so that particular income can be deducted from borrowing cost. Okay, that also can be written in your answer. So now I'm going to give you the calculation, how you are going to calculate. Right, the first loan, that means specific loan. Specific loan. First, will calculate the interest. Now that particular loan has been obtained 1st of January 2018. 1st of January 2018. Okay. So first I would calculate if total duration of the project would not be affected due to that suspension, due to that COVID-19 case. So we continue capitalization, right? Continue capitalization. No extended period, right? Right. Year loan amount, interest, or else here you can write what you call installment, interest, then capital portion of installment, then closing capital. Just say more or less similar thing we have discussed when it comes to SLFRS 16 past paper question. Right? If you need further information, you can go and watch that video. So year 2018. So all 12 months, no, because this is the obtaining date. So until 31st December 2018, we have 12 months. So you have been given annual installments. So all figures are in, let's say, thousands. All figures are in thousands. So here we'll take 100,000. 100,000. These all are in thousands. Just assume 100,000. This is the loan value, because 100 million in thousands, 100,000. Then your installment every year 29 million means 29,000. 29,000. Right, 29,000. So 2019, 2020, 2020. There are 3 years now, but in 2020 only we need to take only 9 months. So we'll take when it comes to borrowing cost calculation, but we need to separate the interest amount based on this calculation. Here also 29,000, here also 29,000. Okay. Now interest, what is the rate? What is the rate? The bank loan interest. Bank loan interest is 14%, right? 14%. 14%. So 100,000 into 14%. How much? 14,000. 14,000. Okay, 14,000. Now capital portion in the installment. So in order to calculate that, you need to deduct 14,000 from 29,000. So you will be getting 15,000. Then what you need to do? You need to deduct this 15,000 from 100,000. Then you will be getting closing capital 85,000. So first year closing capital would be taken into next year opening. Here also 85,000. 85,000. Then apply 14%, because this is the loan amount at the end of the, at the beginning of the second year, 2019. So apply 85,000 multiplied by 14%. 11,000 900, that is the interest. So 29,000 minus 11,900, so you will be getting 17,100. So you need to deduct 17,100 from 85,000, then you will be getting 67,900. So 67,900 applied 14%, then you will be getting 9,506. Then that amount should be deducted from 29,000, then you will be getting 19,494. Your closing balance 67,900 minus 19,494. You will be getting 48,406. Now you can see in 2018 the interest is 14,000. Year 2019 11,900. In 2020 9,506. Now we'll take the borrowing cost to be capitalized on this particular loan. Borrowing cost to be capitalized. That's why I said it's very easy calculation, very easy. Now 2018, what is the interest amount? This 14,000, entire 14,000 need to be taken. That can be capitalized. In 2019, 11,900, no issue. Then in 2020, you cannot, because this one for entire year. So you need to take 9,506, 9/12. Approximately you would be getting 9/12. 9,506 divided by 12 multiplied by 9. You would be getting 7,129.5. 7,129.5. Okay. So this is the. So during these now, so we assume that no extended period, therefore that 2 months also would be taken into consideration for the capitalization. Okay, so altogether 14,000 and 11,900 and 7,129.5, you would be getting 33,029.5. 33,029.5. Now what you need to do? Now already you have learned the standard, you reminded, I gave you the summary. So the temporary interest income, deduct interest income. So what is the interest income? 1,700. Okay, 1,700 interest income. So 1.7 million now? Yes, 1,700. So you need to deduct 1,700. Then you can get 31,329.5 is the amount to be capitalized on this specific loan. 31,329.5. Please write down, this is the amount to be capitalized for a specific loan. Right, for a specific loan. Okay, please write down this answer for the specific loan. Then I will be explaining common loan, so how to calculate the capitalization rate, then how to apply that one into specific loans for the phase 1, phase 2 and phase 3. Please write down this. Right. Okay, right. Now we'll go to next part. That's very important. Common loans. In common loans, you should calculate the capitalization rate. Capitalization rate, how we are going to calculate? Interest, weighted average debts into 100. Now we will calculate annual capitalization rate. Okay, so let me calculate it. What is the first one? Loan obtained 12% at outstanding amount 20 million. So 20 million into 12% plus. The second one, debenture issued 13%, outstanding balance 35 million, or 35 million into 13%. That is the interest, no? Plus. Next one, 11% on 50 million. 50 million into 11%. So you calculate them, then you will be getting the interest. Then what you need to do? Weighted average debt. There is no such repayment and all. So you can take the totals of these loans. Here 20 million plus here 35 million plus 50 million, multiply by 100. Yes, what is the rate here? 20 into 12% plus 35 into 13% plus 50 into 11%. 12.45 million divided by 20 plus 35 plus 50, 105, multiply by 100. 12.45 divided by 105, multiply by 100. 11.86. 11.86 approximately. So this is the rate, even though there are 3 rates given. So this is the rate to be taken in order to capitalize the borrowing cost. So please calculate this one. Excuse me, I'm sorry. 11.86. 11.86. Okay, then I'm going to apply this one into phase 2 and phase 3. Phase 2 and phase 3. Okay. Phase 2. Now examiner has clearly given the dates that they have paid. 1st of August 2019, 20 million. 31st December 2019, 30 million. Phase 3, 30th June 2020, 20 million. 30th September 2021, 10 million. Likewise, clearly mention the date. Okay. Calculating all figures in thousands. Phase 2, the 1st of August 2019, the project completion date. So we'll take 1st of August 2019, that is the date that they have incurred. Okay, 1st of August 2019, this is the incurred date. Completion date. The completion date is 30th September 2020, no? 2020. So how many duration? Duration, how many months? From this day to this day, how many months? 14 months, right? 14 months. Then the loan amount 20,000, in thousands, 20,000. 20 million, so I would write 20,000 here. Now rate 11.86, no? Annual rate is 11.86. Annual rate is 11.86. So interest cost, borrowing cost to be capitalized. So we'll calculate it. 20,000 multiplied by 11.86. 20,000 multiplied by 11.86, but that is for 12 months, so you can increase another 2 months. So this value you got 2,372 for the annual year, so this would be divided by 12 multiplied by 14, then 2,760, 2,767.33, right? How did you calculate this? I will show you somewhere here. 20,000 into 11.86, then you will be getting interest for the 12 months. Okay, 2,372. This could be divided by 12, no? This could be divided by 12 multiplied by 40. Then you are going to get this amount, 2,767.33. Right. Similarly, second one, what is the second disbursement? 31st December 2019. Okay, 31st December 2019. That means the 1st of January 2020. Yeah? In other words, so end date is 30th September 2020. No, so how many months here? 9 months. Very simple. 30,000 is the loan amount. That means the paid amount. This is the amount that they are using from the borrowings. So 11.86. Now 30,000 into 11.86. So this value for entire year. So now 3,558 should be divided by 12 multiplied by 9. 2,668.5. 2,668.5. 2,668.5. Okay. Right. Okay, now phase 2 loans already we have taken into consideration. Phase 3, phase 3, 30th June 2020, 30th June 2020. Now in this particular phase there is no such impact. There is no such impact on COVID-19. 30th June 2020, right? That is the date that they have paid another 20 million. The end date is 30th September 2020. So how many months? 3 months. Loan amount is 20,000. 11.86. 20,000 into 11.86 divided by 12 multiplied by 3. 593. Very simple. Then last one, they have paid 30th September 2020. End date they also 30th September 2020. So no months. Here the paid amount is 10,000, 11.86, but since there is no such duration, so we'll put a dash here. Now take the total interest. Take the total interest. The 2,767.33 plus 2,668.5 plus 593. 6,028.83. Point 83, 6,028.83 in thousands. So in these assumptions, what the total borrowing cost to be capitalized. The previous one 31,329.1, 31,329.5, then plus 6,028.83. 37,358.33. 37,358.33. Okay, so with that assumption, this is the total total borrowing cost to be capitalized. Even though 2 months suspended, we assume that we judge that the total project duration would not be affected, right? So this has been considered as a normal thing. So we continue capitalization of borrowing cost. On the other hand, if someone assume that the extended period is available, assume that the period will be extended, right? Period will be extended. So we are going to adjust that. That means from 2 loans, now there is a specific loan and the common loan. Specific loan borrowing cost how much? Specific loans. Here pool. uh, there are few loans. There are basically uh, two loans applicable. The loan obtained date in phase 2, 1st of August 2019 and 31st December 2019. There are two loans. In phase 2 loans there is no such impact because those loans obtained 30th June 2020, then after suspension period, so no need to consider about it. But here specific loan and the common loan phase 2, these are the amounts paid dates. Here 20 million, 20,000, or rather here 30,000, right? In the specific loan you need to remove 2 months from 2020 interest. 2020 interest how much? 2020 interest already we have calculated 9,000. Already we have calculated 7,000. See this one, for 9 months we have calculated 7,129.5, right? So that is for 9 months. So you need to remove further 2 months, right? So that could be done from this value as well, right? 9,506 divided by 12 multiplied by 2. How much that you are going to remove? 1,584.33. 1,584.33. Let me go and remove that one. 9,506 need to be divided by 12 multiplied by 2. So you are going to remove that interest. 1,584.33. Then similarly you need to remove another 2 months from here, another 2 months from here. So what is the total interest? Or the total interest for the 20 million? We have taken 14 months, no? We have taken 14 months, right? So let me calculate. So total interest value was 2,767.33, no? This one for 14 months multiplied by 2. 2,767.33 divided by 14 multiplied by 2. So you would be getting 395.33, right? So those are that is the amount to be excluded. Similarly, for this loan you have capitalized 2,668.5. This one for 9 months. So you need to divide by 9 multiply by 2. So those 2 months need to be excluded if we are assuming the period would be extended. So 2,668.5 divided by 9 multiplied by 2. 593, right? Now take the total of these 2 months interest. So So you would be getting 2572.66, 2572.66, right? Then now this amount should be deducted. Now total borrowing cost to be capitalized. In previous calculation, you know the total value here. How much? 37,358.33. This is for entire months without excluding 2 months. But now we are going to exclude 2 months, right? 37,358.33 minus 2,572.66. 37,358.33 minus that answer, so 34,785.67, right? So this is the answer. If we exclude that 2 months suspension, right? Suspension. So I have given two answers. In your examination, you clearly made your assumption and provide the answer. Right? Provide the answer. Okay. So I hope you understood this calculation and the application of borrowing cost standard. I hope you enjoyed the session, right? I hope you understood how to apply borrowing cost standard into the real world examples, right? Okay. So with that, I'm going to conclude this particular paper discussion. So I hope you understood application of borrowing cost standard. Then I take this opportunity to congratulate for your final examination. Maybe next couple of weeks you will be facing your final examination. So please read the questions and the instructions carefully and apply the knowledge and the thinking of your standards, all the standards, right? Okay, thank you very much for joining and watching this video. Thank you very much again.